If you're looking for the best Vanguard index fund, it's tricky.
It's tricky. Very tricky.
Vanguard has over 75 different index funds, so it's not surprising it's hard to know where to start. Today I'm going to break down the top Vanguard index funds while giving you my brutally honest take on whether they're any good or not, and try and help you work out which one you should be using. Everyone has different investing goals when picking a fund, so I'll try my best to adapt and explain who each is best for, while showing you which ones I personally own. First, we have to start with the most famous of index funds, the S&P 500. This one you'll find under S&P 500 UCITS ETF, or the ticker symbol VUAG. This may sound a little confusing. To break things down simply, you've got S&P 500, which is the index it tracks. UCITS, this stands for Undertakings for the Collective Investments in Transferable Securities. This sounds complicated, but all it means is it's compliant with the UCITS, and it must follow minimum standards, like holding a diverse portfolio and publishing clear guidance. And of course we have ETF, which means Exchange Traded Fund. This means it can be easily bought or sold on the stock market. And this here, VUAG, is simply a ticker symbol you can search for to find it easily on different platforms. The fund is what Warren Buffett, arguably the most famous investor of all time and the owner of Berkshire Hathaway, worth $373 billion, says that people who aren't professional investors should be buying. It tracks the performance of the top 500 companies in America. The performance of this fund has been pretty amazing, up 21% over the last year, 94% over the last 5 years, and since all time an insane 2,700%. I'm sure we would pretty much all be happy with that. This has been primarily down to the huge growth in tech companies over the past 20 years, which has been incredible. The version of the fund you'll want to go for is this one, which is the accumulation version. These have only been added pretty recently to the Vanguard platform, which is a huge bonus. What this does is automatically reinvest any dividends a companies pay back into the fund. You could opt to have them paid out to you, which will be paid out, and then you can choose to reinvest them yourself. But the problem is you need to be quick with reinvesting, or you'll miss out on the best days of the stock market. The difference in the long run is quite nominal, but it's easier to have it all on autopilot. The fees for this one are the lowest out of any fund that we'll mention today, at just 0.07%. If you compare that to a typical fund tracking a similar thing, you could save £1,309 on a £10,000 investment over 10 years. It's worth pointing out there are cheaper alternatives to this, as with many of the Vanguard funds, but most people will prefer to pay a slight premium for the Vanguard name. And also, the difference between getting 0.07% and 0.05% is probably not worth bothering about as they're all so low. This fund, of course, is allocated 100% in the United States, and you can see its exposure to different industries. What's important is how closely the fund follows the benchmark set, essentially how close it is to the actual index, and you can see the numbers match up perfectly, which is what we're looking for. Some other funds will vary off this slightly. We can also see the top holdings, the big tech companies being the largest: Microsoft, Apple, Amazon, Nvidia and Google. These are percentages based on how large the companies are on the stock market. If one company were to shrink in size, the amount invested in that company would also change. An important thing to notice when you look at this fund is it's $7.8 billion under management, but it was actually only created in May 2019. So you might notice when looking at this one that the historical data of its performance is actually missing. If you go into the income version, however, this one's been going since 2012 and in comparison has $35 billion under management. This really makes no difference, but what it does is allow you to see the historical performance. So 10,000 invested in June 2012 would be worth over 41,000 today. I think pretty much all of us would be happy with that result. So who is this fund for? I would personally lean more towards this one if you had a longer timeline, 20 plus years to wait. That's because you need to invest over a long enough time for this one to recover. What I find really strange is the fact the S&P 500, which has long been regarded as the best set and forget fund, has now become regarded as a less safe option. And this is because it's all good and well looking at the past 10 years and how incredible the results have been, but if we went back to say June 2000 for example and compare it to November 2007, you would have lost money. Or February 2009, you would have almost halved your money for 9 years of investing. It's only when we look back over longer periods of time we're able to see that upward trend. For example, if you were investing prior to 2000, you'd have probably thought the market was moving up, pretty similar to how it is today. But it's only when you notice this period here where realistically it was pretty rocky, and it was only 13 years later when it really started gaining that momentum. Now of course that is an extreme example. We're presuming you'd have put all of your money in at one point and sold it at another. In In reality, you would have bought all of these points along the way and still made a nice return. But it's important to show you to illustrate that past performance does not guarantee future results. When you compare these index funds side by side, the S&P 500 based purely on results alone would be the winner. But it's important to realise it's not always the case. And the S&P 500 may not be the winner in the next 10, 20 or even 30 years. So what do we do about that? Well, let me tell you. But before I do, I want to say a huge thank you to InvestEngine for sponsoring today's video. InvestEngine are such a great fit for today's video because they're the place I would recommend you buy any of these index funds. This is where I buy my Vanguard index funds because their DIY platform offers an amazing 0% platform fee. If you were to buy these directly from Vanguard, you would pay 0.15%, which scales up to £375 for the year. They also have some really nice features like savings plans, which allows you to easily buy into these index funds every month, as well as portfolio rebalancing, so if you want to buy multiple funds, you can easily set certain percentages to have off each and just buy them with one payment. They really are the lowest cost ISA on the market right now, so I would definitely recommend checking them out. It's also so good when a sponsor fits a video so perfectly and is something that I personally use. They currently have a welcome bonus of up to £50 when you sign up, which I'll pop in the description down below. Okay, so we know that the S&P 500 drives amazing growth with its companies, but the question is, will it last? In Vanguard's own 10-year economic forecast, their models have projected higher returns for non-US developed markets and emerging markets, between 7.2 and 9.2%, than US markets, which is estimating to be 4.7 to 6.7. So if we're to believe Vanguard, then we've got a couple of options of how to get around that. The first is this one, the Vanguard FTSE All World ETF, ticker symbol VWRP. The big difference you'll find with this index fund is it has a larger fee, 0.22%, which is still low. But whereas the last one had 500 companies, this one has 3,664 companies. If we look at the portfolio breakdown, we can see how this works. So you can see in a similar way, if we look at the benchmarks, so we compare this fund to the FTSE All World Index, which is what it tries to match. While the majority of the numbers are the same, the number of stocks it holds are actually different. This can happen for a number of reasons. Sometimes it's because of how the index fund is set up. They don't feel like they need to hold all of the positions in some of the smaller companies to get the same results. In fact, if you look at the performance versus the benchmark, you can see it's almost negligible. So it's really not something that you need to worry about. The big difference in this fund is when we look at the market allocation. The United States makes up 61% of this fund. So you're still getting that growth from America, but you're also getting a range of other countries in there. We've got Japan, United Kingdom, China, France, Switzerland, Germany, and more. This is split between 63% in North America, 16% in Europe, 10.5 in the Pacific, and 9.5 in emerging markets. So you're getting diversification across a wide range of markets. This one's a similar story to before, as you'll find with most Vanguard funds, that the income version has been around much longer and it has more in it. Now, I shouldn't really be showing you this. If you look at performance, your 10,000 investment would have grown to 29,000. Immediately, you would think the S&P 500 fund has performed better. But this is where we have to remember the charts don't matter, and it could go in any direction from here for the next 10 years. This fund was my original fund that I recommended to everybody, as it truly is a great fund to just set and forget. You've got a wide range of companies, there's lots of stocks in there to cover you no matter which country or company does well. You can invest each month, set and forget. The next one, which is more of an honourable mention, is one of the most popular funds there are, especially within the financial independence community. This one is the FTSE Global All Cap Index Fund. Ticker symbol, wait for it, VAFTGAG, or BAFTGAG. Yeah, that's a long one. This is very similar to the last fund I mentioned, but it includes more companies. In fact, it's got over 7,000 companies in it this time, so you're getting even more diversity. The fee has a slightly higher charge at 0.23% compared to 0.22%, which is really splitting hairs. And if you were to look at the portfolio breakdown, you'd see by country it's almost identical. And by exposure to different sectors, you would struggle to spot the difference. So the question is, what's the difference? Well, the Global All Cap has more companies. It includes more mid caps, but it also includes a lot more small caps. I know that's not your small local business. Businesses worth anything from around 300 million to 2 billion can be considered a small cap stock, so they're by no means small. But the real question is, do you actually need them? When we compare the two side by side, the stats look pretty similar. The All World actually has almost 3 times the amount invested in it than the All Cap. But it's this chart down here that we want to look at, performance. On the surface, the lines look pretty much drawn on top of each other. It's only when you can zoom in, you can see that the All World Fund has slightly topped it. If we look by year, in some cases one wins and another year another wins. In my opinion, the difference is again pretty negligible. The difference though, and why I lean towards the All World Fund, is because the Global All Cap Fund sounds like an index fund, and it is, but it's set up as a mutual index fund. Confusing, I know. This essentially just refers to the structure, and it can be typically traded once per day, rather than as or when you want to trade it. This doesn't really matter to you, but what it forces you to do is buy it on Vanguard's platform, or perhaps another more expensive provider, as Vanguard's costs are already very low. The problem is now, if you were to buy VWRP on Invest Engine, you'll pay the 0.22% fund fee, and then 0% platform fee on their DIY service. All cap, because you can't do that, you're on Vanguard, so you're paying the 0.23% fee, but you're also lumped with a 0.15% fee that Vanguard charges, so it becomes more like 0.38% versus 0.22%. That's not entirely true because that 0.15% is capped at £375 for the year, but that could be an additional £375 a year you don't have to pay for opting for the other version. As your portfolio grows, it will become more expensive, and if you decide to switch later on, you will lose that nice historical data which shows when you've been buying, so that may be worth considering. The next fund is the one I buy in my portfolio and is one of my favourites. The FTSE Developed World UCITS ETF, ticker symbol VHVG. This one is a nice diverse fund with over 2,000 holdings, but this time you'll notice it has a much lower fee, just 0.12%. It might seem like nothing, but as I'm quite an aggressive investor, I invest realistically £2,000 per month, especially including the government's bonuses to my pension. The difference for me between 0.22% and 0.12% is roughly £23,000 over 25 years. It might not seem like nothing over that many years, but I think it's not to be sniffled at, especially if you think that money could be compounding instead, which would make the difference even greater. The main difference with this fund in my portfolio breakdown is that it doesn't include emerging markets. Our main regions are North America, Europe and the Pacific, with a small part in the Middle East. And we can break that down by country more specifically to see there is a heavy weighting to the US, around 70%, but you've also got companies like Japan, and the UK is in there too. There's a version of this fund which excludes the UK, but I think it's worth including them. We also do benefit slightly from UK holdings with something called Own Currency Advantage, which I feel gives a slight boost to some of the lackluster performance of the FTSE. If you did want to exclude it, this is the one you need, but personally I don't feel like it's worth doing. There's also a slight increase in the fund charge for doing so. If we compare this fund to VWRP, it actually has performed better over the past 5 years, but that's mostly due to a higher weighting towards the US and shouldn't be used to predict the future. So how do I solve the problem of not having emerging markets included? This is a fund you want, the FTSE Emerging Markets ETF VFEG. This one contains over 2,000 emerging market stocks and has a slightly higher charge at 0.22%. The way to get around this and to lower the cost is to use emerging markets for around 10% of your portfolio, and 90% of it could be the Developed World Fund at 0.12%. This balances out the fee to around 0.13%. This is what I do with my personal portfolio in my two-fund strategy. The difference here is we're almost 100% in emerging markets. There's a tiny percent in Europe, but you can ignore that. What's notable here is the country allocation is much different. China, India, Taiwan, Brazil, Saudi, the list goes on and on. It's lots of solid emerging economies. The question you're probably thinking about here though is, do you actually need it? This chart is actually very interesting. It compares developed countries with emerging markets. On the surface of it, we compare the two over 30 years, and you can see that developed has done 400% and emerging 100%. It looks like a no-brainer. I mean, why would you even choose 100% over 400%? But when you shrink the chart down to 20 years, it becomes more interesting. There's been clear periods where emerging markets have outperformed the developed. This is due to a number of reasons and is a topic for an entire other video, but essentially they tend to have things like less debt and can sometimes develop much more quickly and take bigger leaps than developed countries can. The larger you get, sometimes things just slow down. I remember the first chart presumes you're buying it once and then leaving it. If you were to consistently buy over this time, you'd have bought when things were down and benefit from big rises. Over the past 5 and 10 years, developed has won, but remember Vanguard is predicting emerging to outperform North America in the next 10 years. I don't think you want a huge amount of this in your portfolio. I think 10% is the maximum I would go for. You can do this yourself and put 10% in there, or choose to go something like VWRP, which does it all for for you, but you'll pay higher fees for them doing so, an extra 0.9% per year. The way I do it is use the rebalancing tools, which makes it nice and easy. But equally, I think if you don't like emerging markets, although I think it's debated as being part of a balanced portfolio, I really think over the long run, you may not really miss out. Next, I have to mention these or the dividend lovers will crucify me. I had someone ask me the other day how much they would need to invest to live off $2,000 per month of dividends, and I said you would roughly need $800,000 purely to live off the dividends. I personally think if you're invested in dividends, the best option is to go for a dividend paying ETF. This way you don't have to spend all of your time picking the right dividend paying companies or wondering if one may cut their dividend or not. Some will enjoy that, but this is much easier. Now there's two ways of doing this in my opinion. First one is this, the FTSE All World High Dividend Yield ETF, VHYL. Ignore the fact there's an accumulation version of this, I think it's very strange for a dividend paying fund, but this one has 1,800 companies in it and is split over different countries quite broadly. Only 45% in America, with the rest split quite evenly, and within there you'll find some of the biggest, most reliable dividend payers in the world. The downside of this one is there's a 0.29% fee, which is quite high. What you could do alternatively is go for this one, which is a Vanguard FTSE 100 ETF, VUKE. It might sound a little strange, but bear with me. This one only has a 0.09% fee, so you're saving 0.2%. And of course with this one, you are 100% based in the UK. But the FTSE 100 isn't the best representation of the UK economy. That's because a lot of its business is done overseas. And the FTSE 100 also has a lot of your very solid, boring, dividend-paying companies like Rio Tinto, Diageo, BP and Unilever, just to name a few. If we compare these two, actually the dividend ETF pays 3.48%, whereas the FTSE is paying 3.82%. Although if you compare them side by side over 5 years, the dividend one has outperformed in terms of growth. There's a couple of things to consider here, like you don't pay withholding tax on dividends from the UK, which has helped the yield. And of course you've got the lower fee to calculate into that equation. And the fact we also benefit from own currency advantage. Although my gut feeling here would be if you purely wanted reliable dividends with some growth too, the dividend one would be much better in the long run. And of course that fund's goal is to focus purely on dividends where maybe the FTSE 100 isn't, although those companies do pay a good dividend. Dividend companies in general don't tend to be linked to high growth, as they pay out their income rather than reinvest it to grow the company. So in the majority of cases, the two don't tend to go hand in hand. I certainly wouldn't recommend the FTSE to anyone looking for long-term growth, as it simply just doesn't perform anywhere near the S&P 500 or the world funds, as much as I wish it did. Who knows, maybe we'll be pleasantly surprised in the next 20 years, but I wouldn't bet the bank on it. Now you might have noticed something quite notable on the last ETF, and this is within the FTSE 100, and it's this. Some of the largest holdings within there are Shell, BP and British American Tobacco. An increasing amount of people don't want to invest in these companies because they're deemed unethical. I think the majority of people would like to be more ethical as investors, and this is where you may want to consider an ESG fund. ESG stands for environmental, social and governance. They're criteria that can play a role in deciding what an ESG fund invests in. This could be how the company affects things like climate change, deforestation, pollution and waste management. In another bizarre plot twist by Vanguard, this is the one to go for, V3AB, which is their ESG Global All Cap, and it's actually an ETF, whereas a normal one isn't, so you could buy it on Invest Engine to save the fees. The fee for this one is slightly higher, 0.24% versus 0.23%, which is a pretty small difference. The fund is also quite similar in terms of distributions by country. What you'll notice as being the main difference with this one is when you look at things like allocations, energy for example is a much lower percentage of the portfolio, 0.2% opposed to 5.4% in the normal fund, so it's excluding those sorts of companies. Now I have to admit my verdict on this one is still out. If you want the global all cap and want to be a bit more environmentally responsible as an investor, or at least feel like you are, this is a good option. But there also currently exists a premium on ESG companies as they are becoming more popular, so that could also affect performance. The other thing is when you realistically look at the companies in there, I mean you've got Apple, Nvidia, Facebook, AstraZeneca, Pfizer, it turns into thinking a bit like how ethical do you go? I suppose it's a bit like eating more vegan. You could stop eating certain things, but you could also also go in and exclude everything like the clothes you wear, how you travel. It really depends on how far you want to go and what you're comfortable with. I feel like these funds, although companies do hit a criteria, which is good because it forces them to be more positive, a lot of professional investors will laugh at ESG funds and feel like they exist mostly just to tick a box. I'm still not too convinced, but let me know what you think. If you have any questions about any of these funds, let me know, and be sure to follow along as I always share with you guys how I'm doing. If you want to see exactly when I buy and sell, you can check out my Patreon. I do regular updates, and you can ask me any questions directly. And you can also check out my latest portfolio update right here, where I share everything that I own. And I'll catch you guys over there. Thanks.